All right, good morning. Welcome back here to Trader Minute. Great to have you aboard. Let's go out and take a look at a few things here this morning. Market's down a little bit. It's one of those looks like a big down day compared to what has been, but the reality is it's just trimming off a little bit of yesterday's gains and really not all that much. In fact, the S&P I think has actually gone green since I started this. So we're not talking about any kind of mass major move or any type of anything that's game changing out there so far. I do think there are some interesting things to keep an eye on. But let's go out. We're going to take a look at the yield curve and this notion that the yield curve has normalized. Because yesterday, as I turned on the TV, as I kind of just absorbed and listened to things, there were several areas where I heard people talking, and some very smart people talking about yield curve normalization, and that the yield curve was normalizing. And I just rolled my eye and thought, man, this has to be an April Fool's joke because yield curve normalization. Okay, well, here's the data, right? Here's the data right now. And yield curve, generally, the front end is cheaper than the back end. And we do have that, right? We absolutely have that going on. And the 30-year back here is 2.89. The 1 month is 2.42. That's not much of a curve. That's not much of a difference here, but it is a positive yield curve. 2 months is 2.43. Same rate to borrow for 3 months. A little more expensive to borrow for 6 months. And then you go to 1 year, and it is cheaper to borrow money for 1 year than it is for 1 month. I'm not sure that's yield curve normalization. For 2 years, it's 2.33. That's anything but yield curve normalization. In fact, it's cheaper to borrow for 2 years than it is for 1 month. Heck, why not throw another year on that? It's even cheaper, 2.29. This middle side of the curve is inverted. It's absolutely inverted. And I know the traditional thought is yield curve inversion is when the front end and the back end are different, but the middle part of this curve is absolutely inverted, out there. Now, does that mean everything's going to go to hell in a handbasket? No, it doesn't. But we saw a rally in the banks. We saw a kind of a big boost in the banks yesterday on this talk of yield curve normalization. And the reality is there wasn't yield curve normalization. There was a little bit of boost in the 10-year yesterday. In fact, if I come in and bring it up here, we'll go TNX. You can see the Treasury yield for the 10-year bounced, right? And so we did see that element come into play where yes, it's not as inverted, but it's still, we're still talking about inversion, going on here with it. But, that did lead to a little bit of a rally or a big rally in the banks yesterday. But as far as yield curve normalization and that notion, wow. Yeah. Just wow. It is absolute, it's absolute just mind-boggling from a overall just kind of outsider looking in to kind of hear that type of argument, to kind of hear that type of rationalization going on. That's not exactly a rationale that we've heard over the years. And if you want to start taking a look at bonds in global markets, they're definitely inverted now. As one quant, one very very famous quant fund manager, by quant meaning it's just all data driven. Quant trader had to say, what was it last week? Basically, the market makes some of its best gains when the yield curve is inverted. What's he referring to? He's referring to the end of bull markets. Yield curve inverts. Generally, that signals the end of the bull market, but it's 6, 12, 18 months away from a bear market, and generally you get a blow off the top. We saw that happen in 2007, and the yield curve inverted in 2006, and market rallied through 2007 with a couple sharp declines, but hit a new high there in 2007. We've now been dealing with a middle inversion in the yield curve now for bounce, right? And they're going to run with this bounce here a little bit, but this yield curve fear is going to come back. I think we are in one of these types of bounces like this right here in October. And okay, great. Fine. It bounces, great. It's at the retracement. I do think though I don't think there's any sign that it's ready to happen right here or to go, position for it right here and right now. So anyway, that's my thought there on the yield curve. LYFT. LYFT IPO'd, and this is a company here that they're releasing stock. What are they essentially doing? They're selling themselves and issuing ownership or issuing equity, which is essentially ownership. And, the stock's been sold pretty much since the IPO. Today, it's finally seeing a little bit of a bounce. Options, I this out of an IPO. Now, it doesn't mean it's doom and gloom for the stock. We've seen IPOs go like this, and then the stock, rip higher, but not exactly a blazing start here to the IPO. I heard one person on TV yesterday argue that the IPO for LYFT is a reason why they are selling the market and why they think the bull market is coming to an end, because there's not demand for a new IPO. And it's an argument that's an interesting one, and it's one that holds a little bit of water. We have seen some markets where IPOs have been oversubscribed and have been sold off on their IPO, and the market falls afterwards. For me, though, the data and the overall look and the context of that argument, it seems to be very circumstantial. Where, okay, yeah, there's always IPOs, so there's always going to be one that happens before a bear market. And you know what? There's always going to be some that, get bought up initially and some that get sold off initially. Me personally, I just don't read too much into it. I don't take anything bearish from it. His own individual, bubble right here, and the overall market, it's not going to push it higher. It's not going to push it lower, and I don't think LYFT going up or down says a whole lot about the market. And I know that's not the common consensus, but I have not seen any kind of data where there's not super big flaws in the data, where you look and you go, well, you're pulling out a data set or something like that, where it's nothing but coincidence. And it's not a cause or a symptom. It's coincidence, in my opinion. And it may be coincidental that LYFT ultimately is looked back upon and people say, well, that's where the bear market started, and that could be. But it's not going to be because the LYFT IPO was a little bit soft. It's going to be because of earnings, because of economics, and the softness that we see really starting to creep in, to that area around the world. So, anyway, that's my thought on LYFT. As you know, I don't really trade IPOs very much. Especially when they don't have options. So I'm not, I don't have any skin in this game with LYFT. Now, we also saw another element coming into the market, or we see another element coming into the market right now, and it's called a golden cross. A golden cross. Sounds pretty bullish, right? And that is basically where the 50-day moving average moves up above the 200-day moving average. And it's something that you've heard me talk about in the past, and talked about individual stocks with this. And I don't look at this as a buy signal or a sell signal when it goes the other way, like right back here. But it is something where when stocks have this 50 rising, and it's trading above a rising 200, the stocks tend to go higher. When it's inverted, the stocks tend to go lower, just on a longer term basis there. But I want to kind of show you something here in this recent, in this recent cross, right? The market had what's called a death cross, okay, right here at about 260 on the S&P. That's when the 50-day moving average moves below the 200-day moving average. That's kind of referred to this as a death cross. Market coincidentally sold off afterwards. Now, did it sell off because of this death cross? No, we can go back and look at plenty of death crosses where it was just bought up, okay? But if we look at the performance of the market between the death cross and the golden cross, right? If we look at the performance of the market here between these two crosses, the market's actually higher. Is death cross really all that bearish for a market? Is golden cross really all that bullish? It's one of those where when you look long term and you look, very long term at the data, yes, it is. In the short term, is there a whole lot of validity there? No, not really. It's one where if you're going out and buying just because of a golden cross, you're probably going to be in a bad way. If you're selling due to a death cross, you're probably going to be in a bad way. Now, what's really interesting is how infrequent this type of crossing action has been. In fact, 2016 was the last golden cross, and you know what? This is the first one since 2016. 3 years later. 3 years later is when the next golden cross is. That's pretty amazing. But you can see right back here in 2015, a death cross followed by a golden cross, right? And did the market really rally all that much after the golden cross? No, it didn't, right? It pulled a death cross, very shortly after, right as the market was bottoming. And the market spent a month and a half bottoming before going on higher. It already made a big move up before the golden cross. In fact, the market rallied, 20% before the golden cross. So, from a trade signal standpoint, I don't see a lot of logic in it. From a, hey, are you going to establish bullish or bear positions and risk reward on other triggers? Based on it, sure. Absolutely. But in terms of a signal to buy and to sell, this is something that I would tell someone with an IRA, and they have everything allocated aggressively. And all right, you see a death cross, okay, allocated a little less aggressively. You see a golden cross, maybe you want to get a little bit more aggressive, in terms of that very long term type of element. But this is the last 5 years. We don't see it happen very often. I think if you were to interview fund managers and go, well, are you making decisions based on a golden cross or a death cross? They kind of roll their eyes at you and go, what type of voodoo are you talking about? Is this like looking up at the stars and seeing some movement, and now you predict something's going to happen here on Earth, right? That's kind of the same type of notion, and there's going to be data sets that suggest, hey, you know what? Yeah, golden cross, it goes up, and it's always that case in a bull market. Golden crosses go up. When it turns from a bull to a bear market, golden crosses go down. And in fact, if we back this data out just a little bit further, let's come here to 15 years. Let's see if we can see it. No, it didn't quite have it right here in 2008. But this was an area where a lot of stocks started to have golden crosses on them during the summer of 2008, and there was a lot written about it at the time. The SPY didn't have it. The Dow probably did. I just remember a lot being written about the golden crosses that happened at this time period. Let me see if the Dow had that. Not quite. Let's see, small caps probably not. Yeah, small caps did. Small caps did barely, but overall, a lot of stocks had kind of golden crosses here in 2008. Just before the big old meltdown. So, I don't look at those and read too much into it from a market standpoint. In terms of anything kind of short term or even middle term, but the reality is that when the 50 is above the 200-day moving average, the market tends to go up. I mean, the biggest gains of the market happen when the 50 is above the 200-day moving average. Now, there's nothing to say that it can't kind of whipsaw back or do something like it did right back here in 2015. But anyway, that's that's not going to be what happens next. Will not be determined by the cross on the charts, right? It's not going to be a causation type of a thing. The 50 and 200 is not going to cause something. Now, when I see something like this, I go, okay, what is causing it, and is there validity in what's causing it? And if there is, okay, great. I can kind of change and kind of look at things a little bit differently. We saw this happen with Chipotle Mexican Grill. And, we saw back here in 2018, we saw the Golden Cross, and, we saw the stock push on, strongly higher, and the 50 has been above the 200-day moving average ever since, as the stock is pushing to new, trying to push up to new highs as, the data continues to turn, as the data continues to solidify and actually improve for Chipotle Mexican Grill. And I think it has a lot, this 50-200 concept is a lot more valid with individual stocks than it is for the overall, market here. Okay, so anyway, that's just kind of my take on that. Here. Now, look, I know I've talked bearish here for a little while, and you know where my bearish bias is, but it is not something where the market has given a whole lot. I stepped into some EM for the challenge, some Home Depot for the challenge. I've gotten blitzed on both of them. I am still holding them. I still have some time. I still think I have a chance of making some decent returns here with them. In fact, go look at all the put buying here at 30. I normally would never even bring this up, but go look at all the put buying here at 39.5 for 2 cents. That's put buying. That's speculative put buying going on here today. Now, most of the times the specs don't win, but very interesting to see that, here into the market, especially with that being kind of the measure point for a pullback or what a pullback would look like here with the EEM. It's one where when I sound bearish and the market's going up, I get asked a lot, well, when's it going to turn? When's it going to turn? What has to happen for it to turn? And the reality, when a market turns or when something happens, it always looks different. There's always something different. It's never the exact same thing, right? It's never the exact same thing. But yesterday we saw something interesting. Yesterday we saw some major breakouts. We saw Adobe with a massive breakout. Here we are, breaking a new high, gapped into that new high, held the gains. Beautiful breakout here for Adobe, right? We saw Oracle do something very similar. Gap into a new high, hold those gains, add those gains on a breakout. We saw IBM do something very similar, right? Breaking on out here. You say, well, what do these matter? Well, they're bullish breakouts. They are bullish breakouts. The bulls are in charge of these, and there's no other way to look at them, right? If you're bearish, though, these are the stocks you watch. These are the stocks you watch. Because if Adobe cannot hold its breakout, what does that say? If Adobe can't hold its breakout, what does that say? When we have seen stocks, some of the major components in the market, break out and not be able to hold their gains, that's when we've seen some of the biggest drops in the market. So far, these stocks are holding up. When you look at the major breakout stocks out there yesterday, Home Depot broke out of its range. It had been kind of in this tight range here, and it busted out of its range yesterday, kind of like an Adobe and an Oracle and an IBM. You say, well, okay, fine. It's pulling back a little today. Whoop-de-doo. What is a sign that, hey, you know what, there's trouble? And that's if the breakout doesn't hold. We had a breakout right here. Breakout didn't quite hold. We saw some market pullback come in. And so I think when you look, and Adobe is probably one of the best examples, out there, albeit there are some others like in Amazon, a little bit here. You could argue a little bit with Google from last week, but I'm not going to put Google in that category as it didn't break into a new high yesterday. But these stocks that busted into new highs yesterday, or even that are busted into them today, like a Facebook, right? It lagged yesterday, leading today, very bull market type, action. But we start to see them fail. I think you're talking about a market that's in trouble, right? So far, they're not failing. In fact, everything about them is positive. Yesterday, the market vibe stayed at 3. I know the market rallied, but the market vibe stayed at 3. And, it's still a neutral signal. And how could that be after a big up day in the market? Well, the market vibe doesn't measure up and down days in the market, right? It doesn't, in actually looking at the data, in retrospect and understanding, okay, what's the market performance when it's a bull signal, bear signal, a neutral signal? Yes, it does look at market performance. But in calculating today's signal, it doesn't take market performance into account. And so a 3 means, yes, the bulls control more than the bears, but they have not, stepped in and taken mass control. We see a little bounce in the bullish percent index, but not much, right? This is still, yes, it's still bullish, but not in that, new signal bullish manner. If we look at performances of things like small caps versus large caps, you can see that this is continuing to, we're continuing to see a lag when it comes to the small caps, where the large caps are outperforming in a big way. I mean, the differential's over 4% in the last 30 days, where the SPY's outperforming the IWM. The last time we saw this type of differential, come into play, was back here in October, shortly after this drop. So, we have a big kind of differential there, and one that is still firmly in the bears' control. But this is one of the very few metrics in the bears' control out there. But the bulls are not, they're not grabbing this here and taking this and running with it. Now they are taking and running, a little bit with transports in the last few days. You can see transports, really outperforming small caps, which is quite interesting because normally transports and small caps, they kind of move together. But we have seen transports outperform in a big way. I mean, heck, yesterday we saw the FedEx downgrade and the stock surge. This is one of those I think you could throw in the Adobe category where, okay, it's breaking into a new short-term high. This thing breaks down, market's in trouble, type of thing. So if you're looking and saying, all right, you know what, I want to get aggressively short, aggressively bearish, what are you looking for? You got to see some of these stocks break down. Otherwise, you're still just trying to top pick. Right, you're still just trying to top pick, and there's nothing wrong with that. There's always a time and a place for that. But that's you have to understand that that's what it is. For the bulls, what is it? Is there something a little bit there? There's some opportunities here. I think it's in some of these same old, but it's one of those where you look at something like a Chipotle, which I've been very bullish on. I think this is where you start to have to trim, where you start to have to take it off, where you start to have to say, you know what, it's been a fantastic run, but enough's enough for now, and wait for the next pullback. Chipotle was upgraded this morning. It was upgraded by a firm that has been dead wrong on Chipotle Mexican Grill for a long time. And basically they kind of threw in the towel with an upgrade. When we start to see that from analysts, and then we start to see the stock not really reacting positively, we're getting near a top in the short run. So it's one of those where a lot of these kind of big runners, I do think they're time to trim a little bit, or to take off a little bit, with some of the Chipotle. If you take a look at something like NGLOY, which we've talked about, longer term, this thing caught one of those same type of upgrades here today. This is hitting price targets that we talked about back here in January. So I think some of these are some of these very bullish stories. They're kind of getting a little long in the tooth with some of the action that we see. But from a bull standpoint, you want to go out, trade options, buy something. It's still, you buy with a stop on the prior day's low. And after yesterday, that's not easy because Caterpillar, the prior day's low, is quite a ways away. That's not exactly a good risk reward, right? Not exactly a solid risk reward there. So, you can look at the action today and go, okay, I could buy with a stop on today's lows. And look at that type of element, to come into play for a lot of these. But, you can look at something like a Halliburton. Again, I'm not looking at this from a bullish standpoint, but from a bearish standpoint, hitting the upper band, do we start to see some weakness come in? But from a bullish standpoint, you just buy it with a stop on the prior day's low. And that continues to kind of be the bullish theme, the bullish move here, and continues to be working there for the bulls, no matter what stock you're talking about. And I know Visa looks a little different than Halliburton, and it looks a little different than Cat and all of that, but that element continues to hold up. And then when that element breaks down, you know what, you can pop on out and move on. So if you're just desperate to get in from a bullish standpoint, it's one of those where you just, hey, prior day's low and go. You'll notice J&J early this morning broke, the prior day's low. Gotta go, gotta get out, gotta move on, there with that. Where a Caterpillar, you bought in yesterday using the prior day's low, today, you're in, you're going, and you can just adjust, with the new prior or the new low on the day, each and every day here. Okay. Alrighty, again, my apologies for my voice. It is coming back a little bit better here today, but still not quite 100%. I'll jump back on video a little bit later on here today if I can. If not, I will put my thoughts in the market or my thoughts on things in the message feed there. We do have the jobs report here, coming up this Friday. Some more economic data on the horizon. Kind of crickets last night in terms of data, in terms of news, in terms of catalyst here for the market. And I suspect we will have a few more days of those here in the next 2 weeks before earnings get ramped up. And, it'll be a little bit quieter, minus the days where we have the economic data that gets released. Thanks for hopping on. Have yourselves a great one. And we'll talk to you later. Take care.